In today's episode, we're going to talk about risk, and I'm going to share with you a risk management technique that you can implement in your own trading starting today. The goal of this technique is that it will help you reduce the size of your losses and the frequency of your big red days. I want to teach you how to put the pedal to the metal when the market's hot, but how to just as quickly ease off the throttle when it starts to get choppy. I'm going to use my trades from today as a case study. This morning, I took $2,500 of risk on my first trade. That was the most I was willing to go red on the day on that trade. That trade was a winner. I used the profit as a cushion, and I walked my way all the way up to a profit today of over $76,000. That is real money. Now, let me be the first to tell you that my results are not typical. My name is Ross Cameron. I'm a full-time trader, and I funded my first account in 2001. So I've been trading for a long time. I don't want you to assume that you're going to watch this episode and make $76,000 tomorrow. Being able to make consistent profits in the market takes a combination of skill, strategy, and experience. I'm going to help you jumpstart your learning curve here today, and we're going to talk all about how to get better at managing risk. So let's go ahead and jump onto the whiteboard. We've got a lot to cover, and this is the stock that I trade today. It is up right now 458%. 458%. This is unbelievable. This is a huge move, and this was my biggest winner of the day. But you know what? Let's take a step back. Let's pull up the slide deck because we really do have a lot to cover today. So I'm going to go and put this full screen. We have the whiteboard here, so we're going to take some notes over on the whiteboard. And up here on this slide deck, I'm going to go into presenter mode. I'm going to do slideshow, presenter view. I'm going to slide this over here onto this monitor. And we're going to talk about a risk management strategy that you can implement in your own trading starting today. Let's begin with a little bit of a quiz. So let's level set and make sure we're all on the same page at the beginning of this class. Is this a good place to buy this stock? Now, you already know PRFX made a huge move, up over 400%. But the question is this a place right now where you would be able to manage risk? Because if you can't manage risk, it's not worth taking the trade. So as I look at this chart right now, here's what I see. We have a stock that has how many green candles in a row? We've got, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 green candles in a row. It's incredibly strong, but if you're getting in here for your first entry, you missed the boat. You're buying way too high. So the problem here is that you might be thinking about upside reward. Well, what if this thing goes straight to wherever? Okay, I get it. I like to think about the upside reward too. I'm always optimistic about what a stock could do, but we have to ask ourselves first, what's the downside risk on this trade? And unfortunately, typically the way we look at this is that we look for areas of support and then the next leg up. So right now, the last area of support was way back here. That's 4 big green candles away. That means if we got in and we set our stop at this previous sort of support level, it would be too far away. We would need to be able to make 2 times what we're risking. That's what we're risking. We need to actually get to here just to take profit in order to justify the risk involved with taking the trade. So if we had taken that trade, what would have happened? Well, as you can see, it did go higher, which is wonderful, but this big red candle could have stopped you out. In this candle, it dropped from a high of $10 a share all the way down to about $8 a share. That's a 2-point drop. With 5,000 shares, you could have lost 10 grand. You stop out, you take your max loss, only to watch it rip a moment later. Now, let me tell you, I have done this before, and it is infuriating. There's nothing more frustrating than getting stopped out and watching a stock rip without you. But here's what I can tell you. Whenever that has happened to me, it's been because my initial entry was not well timed. I was giving into FOMO. I was buying too high. I was chasing it. And then suddenly the bottom fell out. And unfortunately, when that happens, you're just in the sort of like deer in the headlights mode because you know you're in too high. And now you're like, if this halts down, I could be totally wrecked. So you just panic sell. You're hitting the bottom. And then oftentimes it bounces right there and goes back up. In fact, I had a trade yesterday that did almost exactly that. So no one's immune to making these mistakes, but you've got to develop a sense of awareness around the way you're trading and certainly monitor your metrics so you can try to improve. Okay, so now let's look at this one. So is this a good place to buy? Right here, this very moment. Of course, the answer is no. Yes, it's true that the MACD is positive. Yes, it's true you've got a nice volume profile, but What we don't have is a pullback. In fact, we have a topping tail, which means this is an extension. Buying at the top of an extension would expose us to way too much risk. So the risk to reward on that trade is not good. What you'll sometimes see people write, certainly in the chat room at Warrior Trading, is RR. They'll say, no RR on, X, Y, Z. And sometimes people are like, what is this? And RR is risk reward. There's no risk reward on this trade. There's risk, but there's no reward. So unfortunately, it's not going to be something that's worth taking. All right, let's look at the next one. So how about this? Now this paints a little bit of a different picture. Here we've got a stock that's squeezing up. It's going sideways right here. So now we're on the first pullback, right? The MACD is open. The volume, not bad. Yeah, you've got a little more volume on that red candle, but overall it's not too bad. And of course, we look at the float. We see it's 2.5 million shares. That's right there. And we know, let's just say, for instance, today the market's really hot. Is that a trade that I would take? The answer is yes. It's a trade that I did take, and it goes from $1.80 all the way up to $2, to $2.40, to $2.80, to $2.90, to $3, pulls back, goes up to $3.60, up to $4. So that down there was a fantastic entry. That was the good entry. Buying it way up here, that would not be a good entry. Buying it way up here, that would be capitulating. Capitulation is when you just give in. You give in to FOMO, you just end up getting in at the very tippy top, and it's almost never a good idea. Now, what about this? All right, so now we actually have that red candle that's formed. So after the red candle has formed, it's created a base off that low. We now use that as our low point, which means that's our max loss. So now instead of the max loss being way down here, the max loss has moved up. So now if we can get in, and I did buy near this dip, and I'll show you my trades as we get into this class. I get in down here, now I'm looking for a move back up through the high. I'm in off support. And look at that, we get a squeeze from 10 all the way up to 12. It's amazing how sometimes beginner traders will find themselves buying the tops and selling the bottoms. And it's like, it's not the intention that I'm gonna keep buying the top and selling the bottom. It keeps happening. Why is it happening? And it's typically happening because you're falling victim to FOMO. You're chasing it. The stock starts squeezing up and you feel like you missed an entry and now it's going higher and higher and you just sort of say, you know what, I'm just gonna get in here, forget it. And then all of a sudden you're in at the tippy top and it flushes. And then you stop out, and where you're stopping out is where more seasoned traders, maybe like myself, are saying, I'm gonna buy this dip. So then we're buying there, it rallies back up from people that are dip buyers, it goes through the new high, and the beginner is like, what is going on? And the experienced traders are like, that was a nice dip trade. Right? So the difference between success and failure in trading can be so subtle. You could be this close to turning the corner. You just have to make a couple of really slight adjustments. And I want to help you do that as you learn about risk management in today's class. So here's the thing that I'll tell you about trading. You've got to be really careful of the negative feedback loop. The negative feedback loop in trading begins with a poor track record. When you have a poor track record, you've got a history of poor decisions, losing money, and emotional trading. Typically, a beginner trader who comes into the market, you can fund an account with real money on your phone in a matter of minutes. And next thing you know, you're pressing the buy button, you're jumping into stocks, but without a strategy, without a system, without a set of rules, what's going to happen? The inevitable happens. You lose money. You start spiraling. After you take that first loss, let's think about what happens. If you can recall back to taking your first loss, you take your first loss, and how do you feel? Angry, right? I'll draw a sad face. You feel angry, frustrated, upset, disappointed. And this emotion is so bad, you want to do anything to turn that frown upside down. And how do you turn a frown upside down? When it comes to trading, if you're upset that you're down $10,000, the fastest way to not be upset anymore, what would that be? To make 10 grand. Boom. Easy, right? Well, that would make you feel better. Unfortunately, it's easier said than done. So what ends up happening is you're in the red, you're super frustrated, you want to go back into the green, and so you start taking more trades. Unfortunately, because you're a beginner trader without a lot of experience or track record, you start losing more money. And this only serves to increase emotions. Now you're really upset. You're starting to spiral, you take more trades, and this becomes a downward spiral. It's the epitome of a negative feedback loop. Because the bigger the emotions get, the more you trade, the more share size you trade. And you can go on a full spiral. And where does it end? With your account imploding, gone. I've seen traders do this. In fact, I've had some days that were pretty bad myself. So I'm not completely immune to it. It's unfortunately something that can happen when emotions get the best of us. So because this is such a real phenomenon in trading, what I want to help you do is, number one, develop the awareness of it. So if you're in this negative feedback loop right now, I'm going to teach you by the end of this episode how to break out of it. So that's number one. Number two, if you're a beginner trader and you're not in this loop, thank goodness, but I want you to be aware of how easily you can fall into it. So if it does happen, you'll know how to get out, but you can also take some steps to avoid being in this place in the first place. So let's talk about the relationship when it comes to risk management of profit versus loss. So today on my first trade, I was risking $2,500. So we have a column here for risk and we have a second column for reward. So let's just do ratios to begin with, and then we'll put dollars behind it. So if you risk $1 to make $1, you have to be right 50% of the time in order to break even. 50% your break even point, right? So if you make $1, lose $1, 50% your break even. If you risk $1 to make $2, you only need to be right 33% of the time in order to be profitable. And see, this is where you can get an edge in the market. So if you think about people who go to the casinos and stuff like that, they're thinking about what are games that I can play that give me an edge. If you're playing blackjack, you bet $25. If you win, you make $25. If you lose, your 25 is gone. So essentially your risk to reward ratio is 1-to-1, which means you need to have really high accuracy in order to be profitable. How do you get high accuracy playing blackjack? Well, you can get a little bit of an edge by knowing exactly what cards to hit, exactly what cards to stay, exactly what cards to double. You could get an edge if you're trading or if you're at a casino where you know how many decks are in that they have in the shuffle, in the shoe. So you know, okay, you start counting the cards, right? But you're trying to get that edge. So success at the casino is a bit of a game of statistics, and most people can't find it. Success in trading is also a game of statistics. And what I have found is that when you understand the relationship between risk and reward, you can position yourself where you avoid the trades that are going to create unnecessary risk. So here, let's just say, for instance, you focus on risking $1 to make $2. Now, this is not an option, certainly with blackjack, but it is an option with trading. You can decide how much you're willing to risk. So let's just say, for instance, we have a stock that's popping up. It squeezes up. You got one candle, two candles, and then we're going to give it a little pullback candle right here. All right, so it gives a little pullback. This creates our pullback, which creates the support level. So now this is support. The low of the pullback becomes support. So now we're thinking, okay, if I buy right here, if I buy, let's say, right there, my max loss is right here, max loss. So then what I'm risking is the difference between my entry and my max loss. So let me show you my first trade from today. So first trade from today, we'll pull it up on the charts here. This was on PRFX. So PRFX ends up making, as you can see, of course, a phenomenal move today. It was really impressive. And I see a couple other stocks that are still moving, which is great to see. So PRFX, we're going to go back here. My first trade on it was coming into 7 a.m. So it's right in here. So my first trade was actually a micro pullback. And I got in, it was right in here. So we had this nice rally up, the little dip, another rally up, a little dip. I like to buy these dips right here. So when I got in here, I bought 25,000 shares. So 25,000 shares, not a small position, but that's what I bought. So my entry, 25,000 shares. Now my max loss on this trade, I set at minus 10 cents. So one of the things, it was the low of this pullback, so minus 10 cents, which means I was risking from my entry to my max loss, 25,000 shares times 10 cents is $2,500. So that was my risk right there. Now, what I knew was that I was looking for a move back through the high. So as we got this first candle making a new high, I was looking for a move not only back through the high, but over the psychological resistance of $7, the break of 7. We broke through 7. We go up to 715, 720. We actually made our way all the way up to a high of 7, just about 750. which was the next psychological area of resistance. And so on that first trade, taking an initial risk of $2,500, I'm immediately in the green by about $8,000. So that first trade gave me a 3-to-1 profit to loss ratio. My risk was 2,500. I made a little over 7,500, 8,000. We'll just round down to 3-to-1. All right, so 3-to-1 profit to loss ratio. Now, if we jump back over to our slide deck, what accuracy do I need in order to be profitable with a 3-to-1 profit to loss ratio? I actually only need to be right 25% of the time. 1 out of 4 trades. 1 out of every 4 trades. As long as I'm right on 1 out of every 4 trades, 1 winner and then 3 losers, at a 3-to-1 profit to loss ratio, I would still be a profitable trader. Now, of course, it's not my goal to be right only 25% of the time. My goal is to be right the majority of the time, greater than 50%. On a good day, I can trade up to 75, even 80% accuracy. I mean, occasionally I'll have a day where I'm higher than that. But of course, if you only take 1 trade and it's a winner, you're at 100%. But if you're trading, frequently 30, 40 trades a day or whatever the case may be, hovering around 75, 80% is really nice on a solid green day. So I broke the ice with this first trade. Now, here's where it gets interesting. So I've got that first trade, which was a profit of about $8,300, first trade. And now I'm in the green. I started the day at 0, right? Just like everyone else, I'm not carrying any trades over from the previous day. So I start the day at 0, which means my highest risk is on my very first trade. Because if that very first trade is a loser, I'm now in the red. I'm having to give back, I'm giving back profit to the market, profit that I maybe made in previous days. My account is going down. So the highest risk for me is on that very first trade. Now, I want to jump over here and show you this technique that I implemented in my trading. So we know about the negative feedback loop, but there's something that I discovered. If we look at my metrics from the last 12 months, you'll notice that there was a real turning point right around here, a significant turning point. And right now I'm sitting at about $350,000 on the month of December, and that does not include today's trades, today's profit of $76,000. So this is actually going to become my biggest green month of the year as of right now. Now we still have 9 trading days left in the year, so of course there's time for me to make mistakes, and hopefully I don't, but there's also time for me to add more profit and make my way up towards potentially $500,000 in 1 month. So there was clearly a big turning point that happened right around here. Let's look at my metrics for the year. Sitting right now at about $1.9 million in trading profit, average daily gain, $8,000. But let's get dialed in on a couple things. My current accuracy across the entire year is about 65%. My average winners right now are $877, and my average losers are $592, which leaves me with a greater than 1-to-1 profit to loss ratio. It's not quite 2-to-1. This is minus 600 rounding up. So I'd have to be at $1,200 average winners for a 2-to-1 profit loss ratio. So I'm at like 1.5-to-1. But what we know about 1-to-1 is if you're right 50% of the time, you're break even. I'm at 1.5-to-1 and I'm right 65% of the time. Now you'll also note that my average hold time is short, 4 minutes. I've gotten really good at timing apex points and breakouts, which means I am looking to take a trade at a place where I think if the stock breaks this level, it is going to rip. It's going to squeeze. And if I'm right, I have a winner immediately. And if I'm wrong, I have a loser immediately, but it's a pretty much instant, it's an instant resolution. It either works or it doesn't, which is why I follow the philosophy of breakout or bailout. So if I get in, it doesn't work, then I jump right out. Now, when we're thinking about profit loss ratio, there's a couple of things that I think about for trading. There's 3 core components of profitability. Your first is your accuracy down here. Your second is your profit loss ratio, and your third is your consistency. Not in any particular order. I'm not trying to go counterclockwise, but just these are your 3 core components. So the way I think about it is everyone, if you're trading right now, you could pull up your metrics and see what your profit loss ratio is. Now, I'll tell you that if you don't know what your metrics are right now, you're doing yourself a huge disservice. You should know this information. You should know your profit loss ratio. Now, let's just say you don't know your metrics and you're like, man, I'm not trading very well, but I can't figure it out. What is wrong with me? Well, let's say I imported your trades. I looked at them in this software. What would I notice? Okay, I'm noticing you're losing money in the afternoon, so maybe you should stop trading in the afternoon. What else am I noticing? Performance maybe by price and volume. Well, you're not making a lot of money trading stocks over $20. Maybe focusing on them is taking your attention away from other areas where you do better. So what I would do is I would say, these are the areas you're doing well. Let's double down on that. These are the areas you're not doing as well at. Let's pull back on those. In fact, if we go to the month of March, last March, I had a difficult month. It wasn't a good month for me. It was a pretty bad month, actually. And this is what my metrics showed me, that golly, I was not doing well trading stocks outside this little range. 2 to 10 was my sweet spot. It was very clear by the end of the month. My metrics told me a story. Now I needed to listen to the story and take the tip and apply it. And so I did. So going into April, what do you think I did? You think I changed? I made a change. I said, you know what, for April, how about let's not trade stocks over $20. Let's keep it focused on lower price. That's where my sweet spot is. And boom, the month of April was a big turning point, right? So if you don't know your metrics, you're leaving so much data on the table that could be telling you what you could do right now in your own trading to get better. So you really have 3 core components that I look at. You've got your accuracy, you've got your profit loss ratio, and you've got your consistency. So these all kind of go together. And sometimes traders will say, well, I don't know which one to focus on. You know, I want to be a more consistent trader. I want to be green more. I don't want to have as many losses. How do I focus on being more consistent? Or they'll say, I want a better profit loss ratio, but my losers are huge and my winners are kind of small. I try to cut my losses faster, but it's not working. What should I do? All right, so this is how I would approach it. What I know is that focusing on accuracy is the starting point. And this, in fact, is the place where you can break the cycle of a negative feedback loop if you're already on one. So if we go back here and let's just, so I don't know if we tied this back in. So let me just go pull up the chart for you 1 second. So if we're back on the chart here for PFRX, this was that first trade where I made about $8,300. So right in here, we got this dip and this rip up to 760. So that was a nice clean trade. It ends up pulling back, kind of going sideways, and then we got another rip higher. Now this one was a little tricky right here because we did have these 2 topping tails. So I took this trade, but I took it with smaller size because I recognized with these topping tails, there was a potential of another one and then to drop back down. So that was kind of a smaller green trade. And then we came back and we did pull back a little bit more. We dipped all the way back down here. We ended up going sideways. And then I'll show you some of the next trades. We're going to switch over to a 1-minute chart. So before I do that, let's finish talking about breaking the negative feedback loop and instead getting yourself on a positive feedback loop. It begins with accuracy. So if you're struggling right now, this is what I would say. Focus everything you can on improving your accuracy. So how do we improve our accuracy? You start trading A quality setups. I can't tell you how many traders get caught trading low quality setups, but it happens all the time. You start trading low quality setups out of desperation. Maybe you're just feeling kind of bored. You're sitting here, you're like, I should trade something. So there's nothing that's A quality, so I'll just trade this, it's moving, whatever. You start doing that, what's gonna happen is you're trading low quality stocks, so your accuracy is gonna decline. So let's say you're typically trading at about 70% accuracy. So 70% accuracy is your average, but you go trading these low quality setups, your accuracy drops to 50%. So what's now happened is you've suffered a drop in accuracy, which means you've introduced more losers. By introducing more losers, especially on low quality stocks, some of them are going to be big. So now you're going to have more losers that contribute to your total average loss. And because you're introducing low quality setups, you're going to have some big losers. Your profit loss ratio is going to decline. So your accuracy goes down. That directly drives down your profit loss ratio, and then that harms your consistency, right? So let's go back to the beginning. Focus on A quality stocks. A quality is going to increase your profit loss ratio because you're cutting out those outlier losses that are really drawing down your metrics. That increased profit loss ratio then feeds higher consistency. Now you've got higher consistency. What does that breed? That breeds self-confidence. So now you're a trader who's got a strong track record, you're building confidence, and you're going to increase your share size. You're going to increase your trade quantity, and that increases your profitability. Now you're on a positive feedback loop. So it's incredible when you're on a positive feedback loop, how it feels night and day from when you're kind of like down in the dumps, you're in a drawdown, you're just feeling hesitant. And when you hesitate, you end up second guessing yourself. You end up missing a stock that does exactly what you thought it would do, but you're just not, you're not on. And you know what? I know what that's like. And I get that too sometimes. When I get into a slump, I'll hesitate more. And then I finally break the ice, but I overcompensate by getting in too high with too much size. And it's like, man, I just need to like reset my brain. So the way to reset, if you're currently in a negative feedback loop, is to bring down share size. Step one. So you need to bring down share size. We'll go on to this side of the whiteboard. So reduce your size, step one. Step two, so size down. Step two is focus on accuracy, quality. So A, quality. And that means you've got to understand what is A quality. So what is right now the profile of A quality setups? So what I'm going to do for you guys is I'm going to put my stock selection PDF guide as a link in the description and pin it at the top comments where you guys can download it. And this will break down for you my 1, 2, 3, 4, 5 criteria for stock selection that I'm using in my trading right now to help me find these big momentum stocks. It's important that you're trading the right stocks. So number one, size down. Number two, focus on accuracy. Do not increase size until you've had a stretch of at least 2 weeks of green trading. Doesn't have to be huge profit. It's not about making a lot of money. It's just about rebuilding that confidence. Because once the confidence comes back, then you'll feel comfortable increasing your size and getting more aggressive. So let's talk about my turning point that happened back in June. There was a big turning point for me, and it began with a big red day. This tends to always be the case, that it's a big red day, kind of hitting rock bottom, where I'm like, okay, what am I going to do differently here? I have a major problem. I cannot keep having red days like this. And so what I often do is I go back to the drawing board and I say, all right, I just need to put everything on the table and figure out what I'm doing right and what I'm doing wrong. For those of you guys who have seen the movie Apollo 13, do you remember the scene where the astronauts, Tom Hanks, are all up there in the space shuttle, and down at Houston, right, down in, I guess, Texas, probably, right, Houston, Texas, I don't know. They're down there, and all the scientists that work there, they put everything on a table that the astronauts have in the space shuttle. Everything they have, they put it on the table, and they say, we got to figure out how to, I think it was like a CO2, carbon monoxide scrubber or something like that. They had to figure out how to create this with what they had. And so like putting together fans. And I feel like that's what we do as traders. We're almost like scientists in a way, research analysts. I mean, we've got to be like so focused on our metrics and trying to find discoveries at how to be better. So we're inquisitive, we're just critical thinkers. We want to do better always. And so what I ended up doing in June was I kind of threw it all on the table, and I was like, all right, I got to dig into my metrics and I got to figure out what's going on, because these big red days are really not fun. I'm frustrated with them. I've got to turn it around. And I can't believe I hadn't noticed it before, but this is what I noticed. On my losing days this year, my accuracy was only 46%. 46% on my losing days. Whereas on my green days, it was close to 70%. That's what was giving me this kind of average of like 65%. I was trading more on green days, so my average is sort of skewed higher to that level. The red days are sort of few and far between. So it's not that the accuracy splits exactly down the middle, but on my red days, my accuracy was very poor. So then I thought to myself, is there a way that I could know that today is going to be a red day sooner so that I could stop trading? Now, I wish my broker could give me a signal like, today's 90% chance being a red day, stop trading now. And you know what? I want to say that if Alexa or Siri were like, Ross, today's about to be a red day, stop trading, I'd be like, get out of here. I am not listening to a robot. I know better. But nonetheless, it would be nice, because I feel like brokers could do more to help encourage traders to slow down when their statistics tell a story that if you keep trading, you're going to lose more money. The problem is there's a bit of a conflict of interest. On the one hand, the brokers don't want to see you blow up your account. They want you to trade for forever. On the other hand, short-term goals, as many of these publicly traded companies that are brokers have, they want you trading as much as possible, so you're generating more order flow, and that increased order flow creates more profit for them on payment for order flow. So nonetheless, I realized that my accuracy on these red days is really quite poor, and I need to figure that out. So this is what I did. I looked at my typical green days, and on my typical green days, I start strong, typically with big size on the first trade, and I'm up like $12,000 first trade, boom, home run, right? But the problem is a typical red day, I'm going deep red because I'm getting smoked on that first trade. And then what happens when we go deep red, right? Let's go back to that negative feedback loop. Big loss, first trade, emotion, sad face, maybe even a couple of tears. And it's probably just allergies, but maybe it's not. So really sad face. And then desperation. So grasping at straws. These are straws. I'm not an artist. And then what's that do? It increases your loss. So now you start spiraling, and all of a sudden you're sitting on a day where in a matter of 15 minutes, you go from break even on the day, so you start the day to max loss or more. It just gets worse and worse and worse. So I proposed a change. And the change I proposed was that I would cap my share size at 1/4 of my full size position until I'm up 20 cents per share in profit, and scale up to full size only if I hit that first profit target. And I said, if I never cross that profit target, the profit target, on the day, that I would stay with quarter size for the entire day. The max loss is always the same as my daily goal. So whatever your daily goal is, the max loss is the same. So the idea here was that instead of trading big size on that first trade, and yes, potentially getting a nice big winner, which would be great, but exposing myself on that highest risk trade of the day of going deep into the red, that instead I would wait, I would be calm, cool, and collected, and I would, on those first trades, I would break the ice with 1/4 of full size. And if that trade was a winner, now I've got a profit cushion. I'm starting to build a little bit of a cushion, and that's something that I can work with. I can scale into that. And if it's a red day, then it's like, okay, I'm glad I was at quarter size for the first trade. I'll take a second trade, but still at quarter size. If it's a second red trade, then it's like, wow, this market's not good. So I'm now down on 2 losses, 1/4 of what I would have been down if I was trading with full size. So now the loss, if it's going to be a red day, is going to be smaller. If I take a third loss, I say, you know what? 3 strikes, you're out. This is not happening. This market is cold. And I'm out with 1/4 of what would have been the loss if I had been trading with full size. And honestly, probably even less, because I'm not emotionally hijacked. I'm not frustrated. I'm not going through this spiral. I'm just accepting that, all right, it's not happening, and I'm out. And it's okay to have small red days. This is a thing that so many beginner traders struggle with. They refuse to allow themselves to have small red days. Small red days are healthy. In totality, if you are green over the course of days and weeks and months, individual days don't really matter. It's the big picture that matters. So it's not a big deal to have small red days. You've got to be able to take those red days with a grain of salt. And so by implementing that change, my days changed a little bit. My typical green day, I'm not hitting that big home run on the first trade. I'm kind of legging in, breaking the ice, getting a little bit of a cushion, now using that cushion to take risk on my next trades and working my way up towards my daily goal, which is $5,000. $5,000 a day is $1 million a year. Now this year I'm above the daily goal, right now at 1.9 million. So this year I've had a lot of days where I crossed the daily goal. And just for reference, for those that are curious, when I hit my daily goal, I don't stop trading. I don't stop trading just because I hit the goal. If the market's hot and I hit my goal in my first 3 trades, that's awesome. I'm going to keep trading. I'm going to stop trading once I give back usually about 10% off the top, and I just feel like, you know what? It's not happening anymore. It's best for me just to, call it a day. But this is also a very typical day where I go in the red, but it's not deep red. I'm not emotional. I'm not super frustrated. It's just a small loss. It's no big deal. And I stay focused, trading with small size. And then once I rally up and I get my cushion, then I size up. Now, the trick is, if I go back down to below my initial first profit target, I've got to size back down. And then on a red day here, yes, I went red $3,000. Max loss is $5,000. This is a tolerable loss. I can handle that. So after this change, I proceeded to have 47 consecutive green days in a row. And I realized that in theory, I should never have another red day. Now, this is kind of crazy, but here's why it's true. In theory, I'll never have another red day because as long as I can take 10 more trades every single day, and if I can maintain 65, 75% accuracy, I'll be green. So in theory, I'll never have another red day. In reality, that's not the case. Because if I'm going to be focused on trading A quality setups, there will be days where there aren't going to be 10 more trades. So unfortunately, I run out of setups, I run out of time, the window closes, and I do have to book a red day. So I've had a few red days, which is fine. I've taken a few red days here, over the last few months, but for the most part, they've been pretty small and they've been pretty moderate. So this is kind of what I've noticed with the quality filter. If you're focusing on A quality setups, I can maintain 80, 90% accuracy with A quality setups. 2-to-1 profit loss ratio. In a hot market, I might get 5 to 10 really good trades a day. But in a cold market, well, it's going to slow down. This carried over to the next line, but it might only be like 1 to 3, maybe not even. However, so in a cold market, you're like, oh, there's only 1, 2 setups. Well, maybe I'll take some B quality setups, introduce more trades. Your accuracy is going to go down if you do that. Your profit loss ratio is going to go down, but you will get more trades. You go to C quality, your accuracy is going to go down even more. You will also get more trades, but your profit loss ratio is going down. And so is it worth it? And so I think that there is a line here where if, and this is going to be kind of an interesting graph, but if you only trade A quality setups, you can make money, but you're going to be limited by the fact that, well, that was my 1, 2, 3 trades of the day. I can't take any more trades. So, and this is sort of total profit. So now let's say you get your A quality setups, those are done. Now you introduce B quality setups. So B quality maybe can't make as much money, but you can make a little bit. Your accuracy is a little lower. So you get maybe 5 trades here. And then you say, I'm going to do some C quality setups. So now what's going to happen here? If the market's hot, maybe you keep going higher. If it's cold, well, now maybe you start giving back profit. Now you start giving back profit, say, well, now I'm just going to trade whatever because now I'm frustrated. And now you start to really come back down. So there is a point of diminishing returns. Here's where I like to trade, right around here. The reason I like to trade here is because I like to know that I've hit my peak and come down. You won't know that you've peaked unless you start to come down a little bit off the top. So if I stop while I'm still on the on-ramp, I ask myself, well, how much more could I have made if I just kept trading? So giving back a little off the top, for me, is a good exit indicator to walk away. And that can be 10 to 15% off the top. And that's just a healthy time to walk away. If I give back 50%, that's like a hard stop. I have to stop because if I give back half my profit, I'm going to become emotionally fueled. I'm going to get frustrated. I'll be disappointed. And that's when I'm going to be more apt to make mistakes. There's this book here that I like to recommend, Quit, The Power of Knowing When to Walk Away, written by Annie Duke, professional poker player, and it's really a terrific book. So I think that this would be worth, you can listen to it on audiobook. You don't have to read it if you don't like reading. But in any case, it is a book worth checking out. So when it comes to trading, I think there is kind of a sweet spot there of introducing lower quality setups. It's going to hurt your accuracy, but increase total trade quantity. And in a hot market, it can be worth it. And so the question is right now, what's your accuracy? So something that I actually started doing is while I'm trading, I've got a little whiteboard like this. And, I'm not going to put, some of you guys are going to say, Ross, where's the link to the whiteboard? I'm not going to put an affiliate link to an $11 whiteboard on Amazon. I don't do that here. There's no affiliate links. So any of the tools I recommend, any of the brokers that I suggest, any of the software, whatever, there's no affiliate links. I don't get compensated. It's just whatever you like. So if you like it, use it. I like some of these things, so I'm going to use them. So this is a whiteboard that I like. I'm not going to make an official recommendation on it, but in any case, so here's the thing. What I like to do is while I'm trading, I'll just have a winners and a losers column, and I just kind of start to track it. Oh, loser, another winner, another loser. So, I start seeing, all right, I've got 8 trades here, 9, 10 trades approximately. What's my accuracy, right? So kind of keep a running, like where I'm at, 70%. Because if I start the day with 3 losers, then what do I know? I'm already at 0% accuracy. And now, even if I have 1 winner, I'm still going to be at only 25% accuracy. If I have 2 winners, 3 winners, I'm only getting up to 50%. So like when I start with big losses, I immediately am putting I'm setting the bar really high, which is why it comes back at the very beginning. What do we first have to focus on? If we want to be consistent traders, we have to focus on accuracy. Accuracy is number one, creating that strong positive feedback loop. High accuracy improves your profit loss ratio, improves your consistency, improves your self-confidence, and that's where things really start to pick up speed. So when we look at my trades from today, you can see I'm up currently $76,112.42. That's real money. That's my profit on the day. $57,000 came from PRFX. $21,000 came from TPET. $3,000 came from BPTH. $500 came from PHIO. And then I have these 3 stocks that I was red on. But here's the thing. I started today at 0, right? That was where I started. What's my profit target? 5,000. What's my max loss? 5,000, right? So that's what I know at the beginning of the day, every single day. My profit target, daily goal, and my max loss. I don't know what the day is going to give me, but what I do know is that yesterday we had some incredible momentum. We had a stock that over the last 3 days went up like 2,000%. So unbelievable strength. That's great to see. The market is high. So when I first sat down this morning, the first thing I do is I pull up my scanners. So again, if you download the stock selection PDF that's pinned in the comments, you'll know how I analyze these stocks that are on my scanners right here to decide which one to trade. Now, PRFX is the one that I traded, of course, that I did the best on. PBM is one that I traded earlier, and I actually lost $690 on it. It finally pulled away here at about like 11 a.m. or so, kind of right when I started teaching this episode. So that's great to see. I didn't get any profit on it. Maybe I left some money on the table not trading that, but that's fine. I traded earlier and lost. UAVS I lost, and UKK I lost on as well. But those losses were tolerable. So here's the deal. I started the day, first trade out of the day, A quality setup, boom, I'm immediately up, and we should probably bring the scale in just to be, because we're not gonna be able to go up to 76,000. So immediately, first trade, I'm up $8,000. Within the next couple trades, I'm up 20,000. So I got myself up 20,000 real quick today. Now, I ended up dipping down to 18,000 right here, and then rallying back up to 28,000, and very quickly, I got myself up to 44,000. And when I got to 44,000, that was on TPET. TPET was squeezing. So as I made my way up and then eventually got myself all the way up to 76,000, I never was risking going more red, than my max loss I was comfortable with. But my first trade, the risk that I took was minus 2,500. So that was my initial risk coming into the day. I took that risk on my first trade. If I had lost on it, then on the next trade, I would have had to be careful. Now, 25,000 shares is a big position. That's not really a quarter of my full size today. My full size today, full size right now, probably 75,000 shares. Full size. And that would be on a stock that's super liquid and is lower priced. Now, for reference, PFRX is too expensive right now to take that kind of size. TPET's got 100 million shares of volume, 75,000 shares maybe. PBM has 57 million shares of volume. So we need like a lot of volume for me to take that kind of size. But nonetheless, so today was starting with, closer to, third to even maybe half of full size, which was a calculated decision to take a little bit more risk because this market's been hotter and my average daily gain's been higher. So you need to be able to kind of adjust your share size based on your risk tolerance and what you're comfortable with. But that was my initial risk right there. And this is what I ended up producing. So we ended up having, obviously, a really solid day today. And it began with PFRX. So PRFX, sorry, this one's a tricky one for me. So first trades on it, built the cushion early in the morning. And then what was kind of interesting was this is where I got my initial cushion on PRFX, trading through this move right at 7 a.m. as we squeezed up to a high of 8, right? So we had this first, we can sort of back this up here for a second. So, and what's interesting is on this one, I actually was looking at it. Let's see on the 1 minute chart. I was actually watching it right through here. And I was looking at it right down here for an entry off of support. But what threw me off was that I couldn't find the catalyst. I couldn't figure out why the stock was squeezing. And so I was like, I don't know. Sometimes what you have happen is after a day with really hot momentum, which we had yesterday, traders will jump on anything that's moving, but those moves don't sustain because the stock doesn't really have any business being up that much and it ends up rolling over. So it's very common to have a big red day right after a big green day. And so you sort of have to be careful of that. And that's what I was worried about today. So anyways, so I broke the ice with the first trades. Let's see, what time was this? This was right in this area when we got this micro pullback, which I showed you on the 10-second chart. And then it ends up ripping higher. It goes up to a high of 827 on this second pullback. So by this area right here, I was already up $20,000. So I had $20,000 of profit in my pocket. That was solid. But then it starts to pull back. It's pulling back, and I'm like, all right, well, darn, I guess, I don't know, I guess maybe it's not going to work. So at that point, I switched to trading NUKK. NUKK was one of the strong moves from yesterday, and I traded it this morning, and I got in on this pullback right here. It rallies all the way up to here, and I did something risky. I added full size at $80 a share. It brought my cost basis from way down here all the way up to here, and in the next candle, came all the way down. I had unrealized profit, and I took the risk. It was a calculated risk to double my position for the breakthrough yesterday's high and a squeeze up towards $100 a share, and I lost on it. And I went red on that by $3,300. So that was disappointing, but I already had such a big cushion on the day that I felt that I could afford that risk, and so that was fine. So then all of a sudden we have TPET that pops up on the scanner. So TPET pops up on the scanner, Trio Petroleum. And initially I'm like, petroleum? I don't know. But this thing squeezed up like this. It goes sideways right here, and all of a sudden, there it goes. So as it started to pull away right here, that was that really nice dip entry, this rally up all the way to 360. It pulls back, it rips higher. So I made the bulk of my profit on TPET right in this area, from $2 to $3. Really solid trading. Pulls back, gives us one more push up here, but remember with that topping tail, this was a difficult spot to enter. In fact, today there was an interesting pattern where stocks were kind of going straight up without really a 1-minute pullback. The biggest pullbacks we were seeing were on the 10-second chart. On the 10-second chart, we were getting a decent little pullback, but on the 1 minute, it just wasn't really waiting. So 10-second pullback here, 10-second pullback here, one right there. So anyway, so I traded the 10-second pullbacks on TPET, locked up $21,000 on that, and then coming into the open, PRFX is back in play. And this thing, unbelievable. At the open, it literally goes from $5 a share, from $5 to nearly $17. This move was unbelievable. Had multiple halts up, dip and rip, and this is just classic momentum trading. Now, to get you really dialed in on exactly where I get in and where I get out on these, you've got to be focusing on the 1-minute chart and the 10-second chart. On the 10-second chart, that's where you're going to see these dips, and they're going to be a lot more clear. These are momentary pullbacks. That's all the stock's willing to give is a momentary dip before the rally back up. And if you want to learn how to trade those micro pullbacks, I will also put a link in the description. You can download my stock selection PDF and my micro pullback PDF. That micro pullback PDF is a strategy that I implement every single day when I'm trading. And I use it specifically on strong stocks like this because they often, this thing went from $5 to nearly 17 without having a proper pullback. It just kept going higher and higher and higher. If we look at PBM, you're going to see pretty much the same thing. This stock just rallies from 250 all the way up to 8, hardly pulls back at all. This one, parabolic in a couple little stretches here, a couple bigger red candles there. MACD is now negative on this position, but overall, some really decent action today. So here's what I can tell you. The market is hot. And the best time to learn how to trade was 5 years ago. That way, you're already a successful trader. You're coming into the market right now, and you're able to fire on all cylinders. The next best time to learn is today. So by watching these episodes, by watching as many episodes as you can that I've uploaded here on YouTube, you're immersing yourself in the language of the financial markets. You're just going to start hearing me speak the language, and you're going to start to learn it. So learning how to trade That means learning technical analysis, learning how to choose the strongest stocks each day. And I encourage you to download my stock selection PDF and my micro pullback strategy PDF. And hey, if you want to watch over my shoulder while I'm trading, it's no secret. You can come over here to Warrior Trading and you'll see my P&L. You'll see me getting in and out of these stocks in real time. So I think there's nothing better than getting the real-time market commentary from someone who's been in the market for as long as me. I can share with you the insights that I gain from educated intuition. From all the years I've been trading, I've been able to get to a place where I have a sense of where stocks are going to go. Now, I'm not right 100% of the time. I have losses just like anyone else. And you'll see my biggest green days here on YouTube. And you'll see my biggest red days as well. I don't sweep it under the carpet. I do red day recaps when they come. But the last red day I had was in November. Let's see. So the last red day was, it was actually the last day of November. It was, that was annoying. Yeah, I remember that now. Yeah, $6,000. And that was, again, one of those days where it was like, all right, I'm just out of time. I'm not going to be able to recoup my losses. It's just not going to happen. I still finished the month of November with $339,000 of gross profit. And as we come into December right now, not including today's profit, I'm already at $359,000. So today, that's going to put it up over $400,000 on the month. And right now, to me, pedal is to the metal. The market's hot. I want to try to be aggressive. I want to try to capitalize when the window's open, because you never know how long the market's going to be hot for. The market goes through ebbs and flows, hot streaks and cold streaks. So when it's hot, I want to amplify my risk. I still want to focus on A-quality setups, but I want to be more aggressive. That means taking larger position sizes and trying to jump in a little faster. Now, that strategy in a cold market will not work. So you've got to be able to adapt between hot and cold markets. And that's when you get really good at putting the pedal to the metal and then quickly easing off the throttle. And I'll tell you, that is one of the hardest things for successful traders to get good at. Even traders I've known who have made over $1 million, who've been doing this for years, they still struggle with doing really well during a hot streak and then giving back 20% of it in 2 days when the market cools off. I've been there too. So what I think is the better you can get at starting each day with smaller size, building your cushion, kind of getting a feeler. Is today going to be that red day or is it a green day? That's going to be good. I don't want to be negative and kind of have you coming in every day like, oh, today could be a red day. But on the other hand, we have to think about risk first. That's what separates traders from gamblers. We're really thinking about risk and asking ourselves, can we get a good risk to reward ratio on this trade? If we can't, I can't take it. Listen, if you've enjoyed this episode, thank you so much. I hope you hit the thumbs up. I hope you're subscribed to the channel, and I'll see you for the next upload real soon. And let me remind you that trading is risky. My results aren't typical, so please manage your risk, take it slow, and I'll see you back here for the next episode real soon.